Mr. Tierney.
Thank you very much. And thank all. Let's see if one of these is on. I tend to come down with Mr. Potter here and a little bit critical of the private insurance companies. To my review of things, it looks like they've been pillaging the American consumer for years and have overpriced premiums of the industry where we get far too little in return for our premium dollar. And I think that the new rules that we're putting in this legislation will go some of the way towards stopping that and forcing them hopefully to encourage them to put more focus on value rather than screening out the coverage on that. One of the provisions that we have in the education and labor version of this bill is a requirement that a certain percentage of the premium dollar be spent on actual health care. A surprising notion for some of the insurance companies who have what they call a minimum loss ratio, and I think, Mr. Potter, part of your answer I'll ask you to briefly explain the minimum loss ratio. But in some instances in this country, studies show that that minimum loss ratio is 56.1%. In other words, out of every premium dollar, 56.1% gets spent on health care, and the rest gets spent on something else. Salaries. We've heard testimony of some outrageous salaries being paid, $80,000 a day to one particular executive, enough for another executive to pay the entire Medicare infrastructure for 3 months. Obscene profits, not just reasonable profits, obscene profits, and of course a lot of underwriting that really just is translated to mean how can we not pay your claim on that. Would you talk to us about the importance of having a provision in there requiring a higher minimum loss ratio? The one in our bill is 85%. I'd like to see it higher. But the importance of having a minimum loss ratio stated in the bill and adhered to as opposed to just being left for further regulation.
I think it's vitally important to have some regulation of the medical loss ratio. Since 1993, the average medical loss ratio has declined from 95% to just around 80%. What a medical loss ratio measures is the amount of money that insurers pay out from the premiums they receive. If for every $100 in premiums back in '93, the insurance companies paid out $95. Now it's far, far less than that. One of the reasons for that decline is the consolidation in the industry, the move to for-profit status, and the pressure, relentless pressure from Wall Street to keep ratcheting down that medical loss ratio, and the way that the different kinds of plans that are now dominant. Years ago, when HMOs were operating in a way that they were truly health maintenance operations, and there were a lot of staff model HMOs that have very low or very high medical loss ratios. They've gone by the wayside. There are just not many of those anymore. I think it's very important that you have some kind of floor of this. The insurance industry will try to tell you that a significant portion of the administrative expenses is used to pay for things that benefit patients, such as disease management programs and customer service. McKinsey and Company did a study 2 years ago that showed that that's a very minor part of what they spend out of that. Investors want, as I said, to keep that coming down. They'll penalize those companies if they don't, because they want to have more money being available for shareholders.
Thank you very much. Thank you.
Eddie Bernice Johnson.